welcome. You're watching Your Money Matters here at NDTV Profit. I am Mahima Vajrajani. We're going to take up two very interesting topics today. The first one that we're going to talk about the pros and cons of arbitrage versus income arbitrage. Now, to take this conversation ahead and to understand basically what this means first, and to break that down for us and simplify that for us, we're joined by Juzer Gabajiwala, who is the director at Ventura Securities Limited, joining us now. Juzer, thank you so much for taking up the time. My first question is, with regards to how you can simplify this for our audience, right? Help me understand as to how do you explain the difference between a traditional arbitrage fund as well as an income arbitrage strategy to a retail investor.
So thank you, Mahima, for having me on your show, first of all. So the basic difference between income plus arbitrage and arbitrage fund is, so I'll first explain what is an arbitrage fund.
Right.
So in arbitrage fund, basically what you do is that in the equity market, you buy in the cash market and you sell in the futures market. So your price is basically hedged. So whatever may happen to the market, you know that you are going to get a particular price. So let us say, you have a particular share available at 100 in the cash market, and in future it is quoting at 105, 106. So you can buy in the cash in the spot and you sell in the future. So that is a very plain, simplistic way of explaining it to you. The nuances are always there, but I think from a investor perspective, they need to only understand that much. So what ideally it becomes is that this does not become an equity product. So this is more like a debt product where you are able to predict your return. There will be a little bit of volatility in the arbitrage fund, but that is the nature of the market. But if somebody is, having a holding period of around 6 months plus, then they can look at arbitrage fund. Now I'll just tell you what is the income plus arbitrage. Now, income plus arbitrage actually got created because of a taxation requirement. Since debt fund became unattractive for many investors post 24, when the debt funds also started to be taxed at the maximum marginal tax rate. No indexation benefit was being given to them. But there was a slight change in the definition of how a debt fund and an income fund was, a balance fund was being treated as. So what happened is that now with a 65% investment in a equity fund and 36% in a 35% roughly in a debt instrument, this instrument got created where when it is purely on the capital gains. The only difference is that an arbitrage fund is treated like an equity fund. So when you hold for less than 1 year, the taxation is at 20%. And when you hold for more than 1 year, your taxation is 12.5%. You also get the benefit of that basic 1,25,000 exemption. Whereas our income plus arbitrage fund, what happens over there is that if your holding period is more than 2 years, okay, so that is the critical difference. If it is more than 2 years, then you are taxed at 12.5%. And if it is less than 2 years, then you are taxed as per your slab rate. So that is the main difference between the two categories. So it's predominantly for the retail investors. An income plus arbitrage fund will have lesser volatility because there is already a debt component in that. An arbitrage fund is predominantly used even by the corporates where they would have a 6-month time horizon, HNIs who would want to park their money for 6 months to 1 year. So this is the basic difference between the two.
Okay, got it. Then Juzer, my question is that what kind of market conditions favor arbitrage versus an income arbitrage fund?
So one is an arbitrage funds requires reasonably good volatility in the market,
right,
which we have as of today. So courtesy the volatile scenario, the arbitrage fund is having volatility. So it is purely determined by what is happening in the equity market, and volatility is better for arbitrage funds because then the price movement arbitrage is available. In an income plus arbitrage, up to 65% of the portfolio will enjoy the arbitrage benefit. The balance 35% is roughly is like a debt. The debt component will benefit if the interest rates go down, because when the interest rates go down, there is an inverse relationship on the NAV of the fund. So if you have a volatile market, and we have debt interest rates going down scenario, then income plus arbitrage will give a much better return because you capture even the price rise in the interest rate scenario.
Okay, got it. From what you just spoke about, I wanted to understand as to how then the risk return profile differs for both of these, and how should an investor make a decision when choosing between these two funds.
So one is very clear that arbitrage is more, pegged that towards like a liquid fund plus criteria. When I mean by liquid fund plus, basically what I mean is that you need to have a period of holding of at least 6 months. So if you have a 6 months time duration up to 2 years, then investor should look at an arbitrage fund because it will be tax advantageous. Returns will be varying. Arbitrage funds are typically giving you around 6% return on an average for 1 year to 2 years time horizon. So you can expect that type of a return in an arbitrage fund. Arbitrage plus income plus arbitrage, your holding period will have to be at least 2 years. Because otherwise you will be paying tax as per the marginal tax rate which is applicable to you. So if somebody is in a 30% tax slab, and if his holding period is going to be less than 2 years, so if he redeems from that income plus arbitrage, he will be paying 30% plus tax. So the entire benefit is lost in taxation. So it is a long play on the taxation part, more to do with how to plan your cash flow and on the post tax basis.
Okay. The other aspect is that in arbitrage fund, return of course depends on cash future spread, right? So to help our viewers understand what actually drives this spread and how should one assess it.
So, trying to get into that becomes more like an, equity part of the play. So, I think many investors would not get into so much of depth of that, but always generally you will have that. It's like, time value of money. That today, if you buy something, if you have to buy something in the future, then the price is always higher, right? I mean, so you would always pay a higher price in the future. So that is expecting that the price is going up. So that's a general tendency. Now there could be a scenario where a particular stock could have a reverse situation where the future price is lower than the cash price. However, that arbitrage is not available to the fund house because the fund house can only do buy in cash and sell futures. They cannot do the reverse side of it. So that part of the market is not available for the fund houses.
Okay. And how does the taxation differ for both of these?
So it is like I said, arbitrage fund, because it is characterized by performing in the equity market, and it is also classified as a hybrid. But the nature of the transaction is completely equity, and due to the income tax definition that more than 65% has to be in equity, and because of that, here you have the entire transaction which is there in 65% above. More than that is held in equity instruments. So less than 1 year, it is taxed at 20% short-term capital gain, and more than 1 year is taxed at 12.5%. Whereas in case of income plus, it is classified as a more like a balanced fund. So it is more where 36% is there in equity. So arbitrage is around 36%. 64% is in debt instruments, and depending upon that, the taxation is less than 2 years is taxed as per the slab rate, and more than 2 years is at 12.5%.
Okay. Juzer, do you think that arbitrage funds can replace your liquid funds? This considering the treasury allocation?
No, not exactly, because liquid fund is basically for a tenure ranging from around 7 days plus. So if anyone has around 15 days plus money, then liquid fund would always play a role, and up to 3 months to 6 months, because like I told you that there is a volatility in the equity market. So it is quite possible that in arbitrage funds, in a shorter duration, like maybe 1 week, 10 days, 1 month, you may get a negative return. And most treasuries do not prefer to have any negativity in their portfolio. So liquid fund would continue to be more from a corporate perspective. It would still continue. It is only where if somebody is looking at has liquidity for, let us say, more than 6 months to 1 year, then somebody would look at it.
Okay. And how sustainable do you think is the current arbitrage spreads? And do you see income arbitrage as a tactical allocation or more of a strategic allocation?
So I think income plus arbitrage is, more from a retail investor perspective to better their post-tax return. So where they do not get that much volatility of the arbitrage, they get the stability of a debt and a ticker based on the arbitrage, and plus the benefit of taxation. So you can imagine, like, if supposing somebody is investing in a fixed income instrument, and if he's in the 30% tax bracket, and he says that my holding is as it is, more than 3 years, then income plus arbitrage plays a good role, because he can get a 12.5% taxation. So that's a reasonably good arbitrage in the taxation which is available to the investor.
Got it. So, Juzer, just one last question. In terms of allocating money right now, if you were to allocate certain sum between the two, or maybe a combination of the two, how would you do that?
So any fund which has a requirement of less than 2 years, I would actually put it in arbitrage fund, provided again with a condition that with minimum of 6 months, nothing which is required in less than 6 months, then I would actually allocate it towards arbitrage. And if I have a fund which is available, in 2 to 3 years time duration, and I want the stability, security, I don't want to risk that money because I may have a requirement, and I'm happy with 6.5%, 7% type of a return, then I would look at income plus arbitrage.
Okay, and just one more last question, that is risk that one needs to watch out for both of these.
So risk is that no volatility in the equity market, so no arbitrage opportunities. And from the debt side, obviously you are taking a call on the interest rates, because if interest rates go up, then that is a negative impact on the fund. And to a certain extent, even though it is now much more factored in and monitored, there is also a credit risk, right? I mean, in terms of the debt, the company going under. But I think most of the instruments over there are AAA rated instruments, and G-Secs and short duration. So I think that risk is minuscule, but at the end of the day, that is a risk which is there. So the bigger risk is interest rates. If somebody is expecting interest rates to go up, then at that point of time, this fund is not a good choice.
Okay, all right, Juzer, thank you so much for taking out the time and helping us, break down and understand arbitrage as well as income arbitrage. And thank you so much for taking out the time and speaking with us at NDTV Profit.
Thank you, Mike.